Something absolutely wild just happened in the silver market. And if you don't understand what's really going on right now, you could either miss the opportunity of a lifetime or walk straight into a financial disaster. In the last 24 hours, over $650 billion just vanished. Gone. Silver plummeted from $83 down to $71. That's a 14% free fall that happened so fast, most people didn't even have time to react. Right now, thousands of investors are staring at their screens in complete shock, wondering if they should panic sell before things get even worse. But here's what almost nobody is talking about. While the paper price of silver was collapsing to $72, something completely different was happening on the other side of the world. In Shanghai, physical silver was trading at $89 per ounce. Let that sink in for a second. The exact same metal, the exact same moment. But a $17 difference in price? This isn't just some random market glitch. This is a massive red flag that's telling us something extraordinary is unfolding right before our eyes. And most people will have absolutely no clue what it means. Before we dive deep into this, I need you to do me a quick favor. Hit that like button right now and subscribe to Money Aftermath. Because what you're about to learn isn't just about silver. This is about understanding how financial markets really work behind the scenes. And trust me, you're going to want to stay until the very end of this video. The information I'm sharing today could completely change how you think about investing. Now let's get into it. So what exactly is happening here? Why would the same ounce of silver be worth $72 in one place and $89 in another place at the exact same time? To understand this, you need to grasp one of the most important concepts in commodity markets, and honestly, this applies to way more than just precious metals. This is about the fundamental difference between paper assets and physical assets, between promises on a screen and actual tangible things you can hold in your hand. Think about it like this. Imagine you want to buy a house. You have two options. Option one, you actually buy the house, get the keys, move in, and it's yours. You can touch the walls, you can walk through the rooms, it's real. Option two, someone sells you a piece of paper that says you own a house, but you never actually see the house, you can't live in it, someone else controls it, and you just have the certificate. Most people would obviously choose the actual house, right? But here's the crazy part. In financial markets, millions of people are buying the paper version of assets without even realizing it. They think they own something real, but all they really own is a promise. In the precious metals world, this happens through something called futures contracts. These are traded on major exchanges, and each contract represents 5,000 ounces of silver. Sounds pretty straightforward, right? But here's where it gets interesting. The vast majority of these contracts never result in anyone actually getting physical silver. Instead, they're settled in cash. You buy a contract, the price moves up, you sell the contract, and you collect your profit in dollars. You never see a single ounce of silver. You're not actually buying silver at all. You're just making a bet on which direction the price will move. Now, as long as everybody is happy just trading these paper contracts back and forth, the system works fine. Everything seems normal. But the entire system is built on one critical assumption. It assumes that most people will never actually ask for the physical metal. It assumes everyone just wants to speculate on price movements and collect their cash profits. And for the most part, that assumption has held true for years. But what happens when it doesn't? What happens when suddenly a lot of people start saying, wait a minute, I don't want your paper contract anymore, I want the actual silver? That's when things start to break down. That's when the price of paper silver and physical silver start to split apart. And that's exactly what we're witnessing right now on a scale that's absolutely unprecedented in recent history. In Shanghai, where buyers primarily deal in physical metal that actually gets delivered to them, silver is trading around $89 per ounce. Meanwhile, in Western markets, where most of the trading is just paper contracts being shuffled around, silver is sitting at $72. That's not just a small difference. That's a 24% premium for physical over paper. Now, stop and think about what this really means for a second. If you could legitimately buy physical silver at $72 and immediately turn around and sell it in Shanghai for $89, you'd make $17 per ounce with basically zero risk. In the financial world, this is called arbitrage. And these opportunities usually disappear in seconds because traders jump all over them instantly. But this spread isn't closing. It's not going away. In fact, during today's massive price crash, the spread actually got wider. The paper price fell hard, but Shanghai buyers didn't care at all. They just kept paying $89. So why would they do that? Are they stupid? Are they just throwing money away? No. They're paying $89 because they can't actually get physical silver at $72. That $72 price is an illusion. It's the price of paper promises that might never be fulfilled. The $89 price is the price of real metal that actually shows up at your door. Shanghai buyers aren't overpaying. They're paying the real price. We're the ones underpaying for something we can't actually have. Let me explain this in a different way that might make it even clearer. There's a concept in commodity markets called backwardation. Normally, if you want to buy something today versus buying it 3 months from now, you pay more for immediate delivery. That makes perfect sense, right? If I need silver right now for manufacturing, I should have to pay more than someone who's willing to wait 3 months. But right now, the opposite is happening. The price for immediate delivery is higher than the price for future delivery. This is not normal at all. This tells us there's extreme stress in the market. People are desperate for physical silver right now, and they're willing to pay a significant premium to get it immediately rather than wait. Now, before I continue, I need to give you a quick but important disclaimer. Nothing in this video is financial advice. I'm not telling you to buy or sell anything. I'm analyzing market data and sharing educational information. You should always do your own research and talk to qualified financial professionals before making any investment decisions. Markets are risky and you can lose money. Okay, now that we've got that covered, let's keep going because this gets even more interesting. To really understand what's happening, you need to visualize the structure of these markets. Picture a pyramid. At the very bottom, you have actual physical metal sitting in secure vaults. This is real, tangible silver that you can touch. Just above that, you have the first layer of paper claims. These are contracts where specific bars are assigned to specific owners. Then above that, you have accounts where you have a claim on silver, but not on any specific bars. Then you have futures contracts on top of that, then options on those futures, then derivatives based on those options. Each layer builds on the one below it, but here's the problem. Each layer is way bigger than the layer beneath it. At the bottom of the pyramid, you might have 100 ounces of actual physical silver. But by the time you add up all the paper claims at every single level, those 100 ounces might be supporting 10,000 ounces worth of paper claims, maybe even more. Nobody knows the exact ratio because there's no transparency, but everyone in the industry knows that this pyramid is inverted. There's far more paper than physical. This works fine as long as everyone has confidence in the system. But if confidence cracks, if people start trying to convert their paper to physical, the whole structure becomes dangerously unstable. And right now we're seeing cracks appear. The divergence between paper and physical prices is one crack. The backwardation situation is another crack. The disappearing physical inventory is yet another crack. These cracks are still relatively small right now, but they're growing. And if they continue to grow, we could see something break in a major way. So what specifically triggered today's dramatic events? Understanding this will help you recognize manipulation when you see it in the future, not just in silver, but in any market you're watching. The exchange that handles most precious metals futures made an announcement last Friday. They said they were increasing margin requirements. Now, margin is essentially the deposit you need to put up to hold a futures position. If you want to control $100,000 worth of silver, you might only need to put up $10,000 in margin. The rest is leverage. When the exchange increases these requirements, traders suddenly need to deposit more cash to keep their positions open. If you had $10,000 in margin and they increase the requirement by 13%, you now need to put up an additional $1,300 per contract. If you're holding multiple contracts, that adds up extremely fast. But here's the really important part that a lot of people are missing. They announced this increase during the holiday period when market liquidity is terrible. Many traders are on vacation. Banks have skeleton crews working. Wire transfers take longer to process. Corporate treasury departments are closed. So when the exchange suddenly demands more cash, many traders literally cannot get the funds into their accounts in time, even if they have the money. They have no choice but to sell their positions. It doesn't matter if they believe silver is going much higher. It doesn't matter if they want to hold. They're forced to liquidate because they can't meet the margin call in time. This creates what's called a cascade effect. When forced sellers start hitting the market, prices naturally drop. When prices drop, more traders hit their stop loss orders or face their own margin calls. This creates even more selling pressure. More selling drives prices even lower. Lower prices trigger more stops and more margin calls. It becomes this vicious cycle that feeds on itself, and it can drive prices far below any logical fundamental value simply because of the mechanics of forced liquidation. It has nothing to do with actual supply and demand. Now, the exchange will tell you that this is just prudent risk management. They'll say volatility increased, so they increased margin requirements to protect against defaults. That sounds reasonable on the surface, but look at the specific details. Gold margins were increased by 10%. Silver margins were increased by 13.6%. Platinum margins were increased by 23%. Now look at how much each metal actually fell. Gold fell about 4%, silver fell 9%, hitting 14% at the lowest point. Platinum fell 13.5%. Do you see the pattern? The metals with the highest margin increases fell the hardest. Coincidence? You can decide that for yourself, and this isn't even the first time this has happened recently. On December 12th, they raised silver margins by 10%. That same day, silver dropped about $2, then recovered the next day. So we have a clear pattern forming. Margin hike gets announced, price crashes, then recovery. The big question is whether today will follow that same pattern or if something different is happening this time. The challenge is that today's move was far more extreme, which suggests either there was way more leverage in the system than anyone realized, or there are other factors at play that we're not seeing yet. If you're finding this valuable so far, please leave a comment below and share this video with someone who needs to understand what's really happening in these markets. Your engagement helps more people discover this critical information. Now, let me tell you what's happening in the physical market, because this is where things get really fascinating. While paper prices were absolutely crashing, something completely different was happening with physical silver. Reports from major dealers are indicating that wholesalers are now quoting 3 to 4 week delays on most silver products. Let me repeat that because it's so important. While the price crashed, availability disappeared. Physical inventory that was abundant just a few days ago has now evaporated. People aren't selling their physical silver. They're either buying more or holding what they already have. The crash is purely happening in the paper market where there's high leverage and forced liquidations. This tells you everything you need to know about who's right and who's wrong. Paper traders who are using leverage are panicking and being forced to sell. Physical holders who own actual metal are staying calm and actually accumulating more. Who do you think understands the market better? The leveraged speculators who are being forced out of their positions, or the people who are taking delivery of actual physical metal and storing it? The answer seems pretty obvious to me. Now, let me give you the specific numbers from today's price action because the details really matter here. Silver is currently sitting at about $72.78 per ounce. It's down approximately $7, which represents about a 9% decline from where it started the day. But this snapshot doesn't tell you the full story of what actually happened during this wild session. Last night, during late trading, silver surged all the way up to $83.35. That was the peak, the moment of maximum optimism. Then came the collapse. The initial drop brought us down to around $75. When Asian markets opened, we saw what looked like a recovery attempt. Buyers stepped in and the price stabilized briefly. But that recovery was extremely short-lived. From that point forward, we saw absolutely relentless selling pressure. The absolute low touched around $71 per ounce. So think about that for a second. From peak to trough, we're looking at a $12 swing in less than 24 hours. That's approximately 14%. To put this in perspective, this is one of the largest single-day percentage drops in silver's recent history. We're talking about price movements that would typically unfold over weeks or even months, compressed into a single trading session. That's not normal market behavior. That's something else entirely. Gold is currently sitting at about $4,356 per ounce, down $182, which represents approximately 4%. Notice that gold is falling less than silver. This is actually typical in market corrections. Silver tends to be significantly more volatile than gold. It rises faster during bull markets, and it falls faster during corrections. Platinum took the hardest hit of all three major precious metals. It's currently at about $2,134, down $329, which represents approximately 13.5%. That's actually worse than silver's decline. Why did platinum fall the hardest? Remember those margin increases I mentioned earlier? Platinum margins were increased by 23%, which was the most aggressive increase of all three metals, and platinum fell the hardest. That's not a coincidence. There's a clear cause and effect relationship there that's pretty hard to ignore. There's another indicator that's worth examining here. It's called the gold-silver ratio, and it tells us how many ounces of silver it takes to buy 1 ounce of gold. Right now, this ratio is moving higher because silver fell faster than gold. However, it's still sitting below 60. Historically, when the gold-silver ratio is below 60 during a precious metals bull market, it often comes right before even larger moves higher in silver. The ratio tends to compress further as silver dramatically outperforms during the really intense phases of bull runs. But we'll have to wait and see if that historical pattern holds true this time around. At one point during today's decline, the silver market lost $650 billion in total market capitalization. That's not a typo. $650 billion just evaporated in a matter of hours. Even though we've recovered somewhat from the absolute lows, that's still an absolutely staggering amount of wealth destruction. Interestingly, silver has now fallen to 4th place in rankings of top assets by market cap, dropping below a major tech company again. Whether it stays there or not depends entirely on what happens over the next few days and weeks. Meanwhile, according to prediction markets, the odds of silver hitting $100 per ounce in January fell from 51% down to 16% in just a few hours. Now, I don't personally put much faith in prediction markets for price forecasts, but it does show you how quickly sentiment can shift in financial markets. Yesterday, people thought $100 was more likely than not. Today, they think it's highly unlikely. Neither sentiment may actually be correct. Markets are driven by emotion, and emotions swing wildly from greed to fear and back again. Here's something that should really concern paper traders, but should actually excite physical buyers. Multiple countries around the world are implementing export controls on silver. These controls restrict how much silver can leave the country, prioritizing domestic supply. Now, why would governments do this? It's not random. They're doing this because silver isn't just a monetary metal or an investment. It's a critical industrial commodity that's used in solar panels, electronics, electric vehicles, batteries, and countless other technologies that are essential to the green energy transition. When countries start restricting exports of a commodity, it's usually because they're anticipating supply shortages. They're securing domestic supply before allowing any exports. And these controls are going into effect within just a few days. The window for moving silver between different markets is about to close completely. Once these controls are fully in place, the price divergence between paper and physical markets could become even more extreme because you literally won't be able to move metal from low-price markets to high-price markets anymore. Think about the implications of this for a second. If you can't export silver from the United States or Europe to Asia, and Asian buyers desperately need physical silver for manufacturing, what happens to the price in Asia? It goes up significantly. What happens to the paper price in Western markets if that paper can't be converted to physical metal and shipped overseas? It becomes increasingly irrelevant. The paper price just becomes the price of a promise that can't actually be kept. This is exactly why Shanghai buyers are completely ignoring the $72 paper price and paying $89 for physical delivery. They know that in just a few days, they might not be able to get Western silver at any price. They're paying up now to secure supply before that window closes completely. They're not being irrational or emotional. They're being strategic and forward-thinking. Let me share something that really paints a clear picture of what's actually happening right now. While paper prices crashed by 5% initially and then fell even further, Shanghai just kept buying at $89 while Western computer screens were showing $72. Same metal, same hour, $17 gap. But here's the absolutely critical insight that everyone needs to understand. The gap didn't close during the crash. It actually widened. When you see a genuine market sell-off that's driven by fundamental bearishness, prices fall everywhere around the world. But when you see paper prices falling hard while physical prices stay elevated or even rise, you're not watching a normal market event. You're watching two completely different markets with two completely different realities diverging from each other in real time. The exchange raised margins twice in just 17 days, right into the holiday season when liquidity is at its absolute worst and people can't wire funds quickly. Leveraged speculators got absolutely destroyed. But was this just unfortunate timing, or was it calculated? I'll let you decide for yourself, but the pattern is crystal clear. Margins go up, liquidity is low, forced selling occurs, prices crash, physical buyers accumulate at lower prices, paper contracts settle in cash, physical contracts settle in actual metal. One price is negotiable and can be manipulated through paper markets and leverage. One price is determined by actual physical supply and demand. One price can be suppressed through forced liquidation and margin manipulation. One price reflects reality. Right now, we're watching the paper price get completely divorced from physical reality in real time. The big question is how long this divergence can possibly last before something major breaks in the system. Now let's talk about what this all means going forward, because this is where it really matters for you. The smart money isn't panicking right now. While retail traders are glued to their screens and freaking out over red numbers, experienced physical holders understand something crucial. Nothing fundamental has actually changed. The reasons to own silver are still completely intact. The world is still running a massive deficit in silver production versus consumption. Industrial demand continues to grow year after year. Green energy technologies require more silver than ever before. Electronics manufacturing isn't slowing down at all. Electric vehicles need significant amounts of silver. Solar panels need silver. 5G infrastructure needs silver. The demand side is incredibly strong and getting stronger. Meanwhile, supply is tight and getting tighter. Major mines aren't expanding production because silver is primarily a byproduct of other mining operations like copper or lead. You can't just decide to open a massive silver mine overnight. It takes years of exploration, years of permitting, and years of construction before you get any production. Meanwhile, above-ground inventories continue to decline. Exchange warehouses are showing less and less available silver. This isn't just about investment demand anymore. Industrial users are genuinely struggling to secure adequate supply. The volatility we're seeing today doesn't change any of these fundamental factors. If anything, it actually reinforces them. The violent price swings in paper markets while physical markets remain incredibly tight tells you that paper markets are completely losing touch with reality. The divergence between paper and physical is a symptom of a much deeper problem. There's simply not enough physical silver to back all the paper claims that exist. This is exactly what happened in the nickel market not too long ago. The paper price and physical price diverged so dramatically that the exchange actually had to halt all trading. Forced liquidations drove the paper price to completely irrational levels while physical nickel was unavailable at any price. Eventually, the exchange had to step in, cancel trades, and restart the market at more realistic price levels. Could something similar happen in silver? It's definitely possible. The conditions are certainly there. Now, I'm not sitting here predicting that silver is going to $100 tomorrow. I'm also not predicting it's going back down to $60. What I'm saying is that the current volatility is separating two very different groups of people. It's separating speculators from accumulators. Speculators trade on screens and get violently shaken out by volatility. Accumulators buy physical metal and don't care at all about daily price swings because they're focused exclusively on long-term supply and demand fundamentals. Which group do you want to be in? That's a personal decision that depends on your own financial situation, your risk tolerance, and your investment goals. But understanding the fundamental difference between paper and physical is absolutely crucial to making that decision intelligently. Let me tell you what experienced precious metals investors actually do during extreme volatility like this. They don't panic, they don't check prices obsessively every 5 minutes, they don't make emotional decisions based on fear. Instead, they view volatility as opportunity. When prices drop sharply, they see it as a sale. They see it as a chance to acquire more ounces at a discount compared to where prices were just yesterday. There's an old saying in markets: the best time to buy is when there's blood in the streets. When everyone is panicking, when sentiment is absolutely terrible, when all the news is negative, that's often the very best time to accumulate quality assets. Why? Because prices are driven by pure emotion in the short term. Fear drives prices down. Greed drives prices up. But fundamentals drive prices in the long term. And if the fundamentals are still strong, buying during fear-driven sell-offs can be incredibly profitable over time. Now, I'm not saying that today's low is definitely the bottom. We could absolutely see more downside tomorrow or later this week. The volatility isn't over yet. Paper markets could push silver even lower still. But if the physical market remains tight, if Shanghai keeps paying significant premiums, if industrial demand continues growing, if supply constraints persist, then lower paper prices just create better buying opportunities for people who truly understand the difference between paper promises and physical reality. The key is knowing exactly what you're buying and why you're buying it. Are you speculating on short-term price movements? Then you need to watch charts carefully, set protective stops, manage risk extremely carefully, and accept that you might get stopped out during volatile periods. Are you accumulating physical metal for long-term wealth preservation or potential appreciation? Then daily volatility is just background noise. Your focus should be on total ounces accumulated, not dollar prices on any given day. This is the critical distinction that most people completely miss. They see a 9% drop and think they lost money. But if you bought physical silver yesterday at $80 and today it's worth $72 on paper, have you actually lost anything? Only if you sell. If you're holding physical metal for the long term, you still have the exact same number of ounces. And if the fundamental case for silver is still intact, those ounces will likely be worth significantly more in the future, regardless of today's paper price volatility. Let me give you another quick disclaimer here. I'm not your financial advisor. This is purely educational content, not financial advice. Markets are extremely risky. Prices can go down just as easily as they go up. You can lose money, potentially a lot of money. Do your own thorough research. Make sure you understand what you're investing in. Only invest money you can genuinely afford to lose. And please consult with qualified financial professionals before making any important financial decisions. All right, now let's continue. There's something really important to understand about market manipulation. It exists. It's absolutely real. It happens in many different markets, not just precious metals. But here's what people get completely wrong about it. They think manipulation means prices can never go up. They think it means the manipulators always win in the end. That's not true at all. Manipulation is about controlling volatility and timing to benefit the people doing the manipulating. It's about shaking out weak hands so that smart money can accumulate at much better prices. It's about creating fear when they want to buy and creating greed when they want to sell. But here's the thing. Manipulation doesn't actually change fundamental supply and demand. It just delays the inevitable market adjustment. Eventually, reality catches up. Think about it this way. If there's genuinely not enough physical silver to meet actual demand, no amount of paper market manipulation can change that underlying reality. You can suppress the paper price temporarily, but you absolutely cannot create physical silver out of thin air. Eventually, the physical shortage will overwhelm any paper manipulation. The question isn't if this will happen, but when. We've seen this exact movie play out before in other commodity markets. Look at uranium. For years and years, the paper price was actively suppressed while physical inventories steadily declined. Eventually, the physical shortage became so severe that prices absolutely exploded, despite ongoing attempts at paper market manipulation. Look at palladium. Exact same story. Years of suppressed prices while physical tightness kept growing. Then suddenly, a massive price surge when reality could no longer be denied. Silver might be following a very similar pattern. In fact, we might be seeing the early stages of this exact pattern unfolding right now. The divergence between paper and physical prices is like the canary in the coal mine. It's telling you loud and clear that the paper market is losing its grip on price discovery. Physical reality is starting to assert itself, and that process can be extremely powerful once it really gets going. Now, how long does this process take? That's genuinely impossible to predict with any certainty. Markets can remain irrational far longer than most people can remain solvent, as the famous saying goes. Paper markets might keep successfully suppressing prices for many more months or even years, but the fundamental imbalances aren't shrinking. They're actually growing larger. Industrial demand isn't going away. Supply isn't magically increasing. Inventories keep declining month after month. At some point, something absolutely has to give. What would a breaking point actually look like? It might look like a major industrial user being completely unable to secure supply at any price. It might look like a major exchange literally running out of physical metal to deliver against outstanding contracts. It might look like premiums for physical metal over paper, becoming so massive that the paper price becomes totally meaningless to anyone who actually needs the metal. We're already seeing early hints of all of these things happening. The question is, which one becomes the catalyst that finally breaks the entire system? For investors and traders, the right strategy depends entirely on your specific situation. If you're actively trading paper contracts with leverage, you need to be extremely careful right now. Volatility like we saw today can completely wipe out leverage positions in minutes. Stop losses are absolutely essential. Risk management is critical. You cannot afford to hold through these kinds of moves with leverage because you'll get margin called right out of your position before you even know what happened. But if you're buying physical metal without any leverage, volatility actually becomes your friend. You're not worried about margin calls. You're not worried about forced liquidation. You can comfortably hold through absolutely any amount of paper price volatility because you own the actual metal itself. And during these violent sell-offs, you might even find golden opportunities to acquire more physical at significantly discounted prices. This is exactly why experienced precious metals investors strongly prefer physical over paper. Physical gives you true staying power. It completely eliminates counterparty risk. You don't have to worry about exchange rules suddenly changing. You don't have to worry about contracts not being honored. You don't have to worry about settlement in cash instead of metal when you wanted actual delivery. You own the asset directly and completely. The trade-off, of course, is convenience. Physical is definitely harder to buy and sell quickly. You need to figure out secure storage. You can't trade in and out at the click of a button. But these inconveniences are actually features, not bugs. They force you to think long-term. They prevent you from making emotional decisions based on short-term volatility. They align your interests with fundamental value, rather than short-term price movements and speculation. There's another really important aspect worth discussing here. During times of severe financial stress, precious metals often serve as wealth insurance. They're not primarily about making huge profits, although that can definitely happen. They're about preserving your purchasing power when other assets are declining in value. They're about having liquid wealth that is not dependent on any government or financial institution continuing to function properly. When you see extreme volatility like we saw today, it's completely natural to question whether precious metals are really fulfilling this insurance role. After all, if prices can drop 9% in a single day, how is that insurance? But here's the absolutely key point. The paper price is wildly volatile. The physical metal itself is stable. Your ounces don't evaporate when paper prices crash. The industrial utility of silver doesn't disappear. The fundamental scarcity doesn't change at all. What's happening today is essentially a stress test. It's revealing who truly understands precious metals as insurance versus who views them purely as speculative trades. Insurance always costs money up front. You pay premiums. But when you actually need it, when crisis hits, it becomes absolutely invaluable. Physical precious metals work exactly the same way. You might see paper prices fluctuate wildly and violently, but when financial system stress becomes truly severe, having physical wealth outside the traditional system becomes priceless. If this analysis is genuinely helping you understand what's really happening beneath the surface, please share this video with others who would benefit from this perspective. Knowledge is genuine power, especially in volatile markets like these. And make sure to drop a comment below with your thoughts on what's happening. I read every single comment, and your engagement helps this content reach more people who need to see it. All right, so what should you specifically be watching for in the coming days and weeks? First, and most important, Watch the spread between paper and physical prices very carefully. If Shanghai continues paying significant premiums while paper prices stay suppressed, that's incredibly bullish for physical holders. It means the divergence is absolutely real, and it's growing stronger, not weaker. Second, watch physical availability extremely closely. If dealers continue reporting extended delays and rapidly dwindling inventory despite lower prices, that's extraordinarily bullish. It means paper price drops aren't creating any additional supply whatsoever, which tells you the paper price is completely disconnected from physical market reality. Third, watch for any new exchange announcements. More margin hikes would strongly suggest they're actively trying to push prices even lower through forced liquidation. Sudden rule changes might indicate serious stress in the physical delivery system. Any unusual trading halts or changes to settlement procedures could signal major problems developing behind the scenes. Fourth, watch what industrial users are doing. If major manufacturers start aggressively stockpiling silver or publicly expressing concerns about future supply availability, that's a huge red flag that shortages are becoming truly critical. Industrial users have much better information about real supply and demand than retail investors do. Fifth, watch government actions very carefully. More export controls from major producing countries would tighten physical markets even further. Any talk of strategic reserves or government stockpiling programs would indicate that nations view silver as strategically important for national security and economic competitiveness. Sixth, watch currency markets, particularly the US dollar. Often, precious metals move inversely to the dollar. If the dollar weakens significantly, that could provide a strong tailwind for precious metals prices, even if other factors remain neutral. The next few days and weeks are going to be absolutely crucial. Will paper prices recover quickly like they did after the last margin hike? Or will we see continued weakness and more forced selling? Will physical premiums widen even further? Will availability deteriorate more severely? These are the critical questions that will determine whether today was just another routine shakeout or the beginning of something much bigger and more significant. One thing is absolutely certain. The precious metals market is at a genuine critical juncture right now. The divergence between paper and physical is truly unprecedented in recent history. The level of potential manipulation is becoming increasingly obvious to anyone paying attention. The fundamental supply and demand picture is incredibly bullish for anyone with a long-term perspective. But timing is everything in markets, and nobody can predict exactly when paper manipulation will finally break down completely. For long-term holders, absolutely none of this changes the core investment thesis. The world needs significantly more silver than it's currently producing. That structural deficit has to be resolved eventually. Either prices go much, much higher to incentivize more production and reduce demand, or shortages become severe enough to cause real economic disruption. Either outcome is ultimately bullish for silver holders who have patience. For active traders, the message is crystal clear. Paper markets are extremely dangerous right now. Leverage is potentially deadly in this environment. If you're trading, you absolutely need tight risk management, clear protective stops, and the iron discipline to take losses quickly when you're wrong. The violent moves we're seeing can completely bankrupt leveraged accounts in just hours. For people who are considering entering the market right now, today might represent either opportunity or risk, depending entirely on your perspective and time horizon. If you believe strongly in the fundamental case for silver and you're thinking in terms of years rather than days or weeks, then buying during widespread panic might be very smart. If you're looking to trade and flip quickly for profits, you might want to wait for clearer technical signals that the selling pressure is finally exhausted. The single most important lesson from today is this: paper markets and physical markets are absolutely not the same thing. They can and do diverge dramatically. Paper prices can be manipulated through leverage, forced margin hikes, and cascading liquidations. Physical reality cannot be manipulated at all. Supply is supply. Demand is demand. Eventually, physical reality always wins. The only question is how much pain the paper market inflicts on speculators before reality finally reasserts itself. Understanding this critical distinction will serve you incredibly well, not just in precious metals, but in any market you ever trade or invest in. Anytime you see major divergence between paper and physical, between financial assets and real assets, between promises and reality, pay very close attention. That divergence is telling you something extremely important. It's telling you the system is under significant stress and that some kind of resolution is coming. Will that resolution be orderly or chaotic? Will it happen gradually or suddenly? Will manipulators maintain control, or will they finally lose their grip? These are the questions that will determine not just the price of silver, but potentially the stability of financial markets much more broadly. We're genuinely living in extraordinary times. Unprecedented monetary policy, unprecedented debt levels across the globe, unprecedented asset prices in many markets, unprecedented divergences between financial markets and real economies. Silver is just one small piece of this much larger puzzle. But it's an incredibly important piece because it sits right at the critical intersection of money and industry, of financial assets and physical commodities, of paper promises and tangible reality. Whatever happens next, today was genuinely significant. It revealed the extreme fragility of paper markets. It revealed the remarkable resilience of physical demand. It revealed the widening gap between perception and reality. And it provided an invaluable lesson for anyone who was paying close attention. In the end, reality always wins. Paper can be printed endlessly, promises can be broken easily. Contracts can be settled in cash rather than physical delivery. But physical reality is incredibly stubborn. It doesn't bend to wishes or manipulation. It simply is what it is. Thank you so much for watching this deep analysis from Money Aftermath. If you found this valuable, please hit that like button, subscribe to the channel, and share this with anyone who needs to understand what's really happening in markets right now. Drop a comment below with your thoughts, your questions, or your own analysis. I genuinely read and respond to comments, and the discussion in the comment section often provides additional valuable insights. Stay informed, stay rational, and make all your decisions based on genuine understanding rather than pure emotion. These are the times when clear, logical thinking matters most. Until next time, keep learning, keep questioning what you see on your screen, because sometimes the truth is very, very different from what's being presented to you.